We are done with all the sections of this reading. Now let's look at a summary of the major points. The categorization of intercorporate investments depends on the level of influence. If we make an investment and the influence is not significant, then the investment is categorized as a financial asset. So for example, if a company buys shares or a company buys bonds issued by another company, that would be a financial asset. Typically, the interest is less than 20%. If the influence is significant, then the investment is categorized as an associate company, and here generally the interest is between 20% to 50%. But the key point has to do with influence. Now, at times the interest might be slightly less than 20%, but if the influence is significant in terms of perhaps representation on the board of directors, then the investment will be categorized as an associate company. We can also have joint ventures. This is where two or more companies get together to form a joint venture, and with joint ventures, the different partners have shared control. The percentage of interest varies. And then we can have business combinations. So this is where the acquired company is fully controlled by the investor. This typically happens when the interest is more than 50%. The accounting method depends on the categorization. So for financial assets, the accounting method is IFRS 9. This became effective 1st January 2018. With IFRS 9, there are three major terms: fair value through profit and loss, fair value through other comprehensive income, and amortized cost. So if a financial asset is categorized as fair value through profit and loss, this means that the asset is always shown at fair value. So for example, if a company buys the shares of another company and those shares are designated as fair value through profit and loss, then whatever the share price is needs to be reflected on the balance sheet. Any unrealized gains and losses are shown on the income statement. Then we have fair value through other comprehensive income. Here the asset is shown on the balance sheet at fair value. Unrealized gains and losses are not shown on the income statement, but unrealized gains and losses are shown in other comprehensive income, which is part of equity. And then there might be assets such as bonds, which are held for the long term, and such financial assets are shown at amortized cost. For associates and joint ventures, the equity method needs to be used. Here the investment is initially recorded at cost, and the cost will have three components. There will be the reported value, and then there will be a fair value surplus and goodwill. And this is single line consolidation in the sense that when an investment is made in an associate company, the investment amount is shown as a single line item on the balance sheet. Over time, the value of the investment changes, and that value is basically the beginning value plus the share of profit during a period of time minus the share of dividends. On the income statement, we also have a single line item, which is the share of income recorded in the investor's income statement. The dividends are not shown over here because the dividend is received as cash. If the investor has control over the investee, then the acquisition method is used. Here we combine the assets, liabilities, revenue and expenses of the subsidiary or the investee company with the parent. And then we say that we are presenting consolidated financial statements. Any intercompany transactions are eliminated. For a business combination with less than 100% acquisition, we need to show the non-controlling or minority interest on the balance sheet. US GAAP says that we need to use full goodwill, whereas IFRS says that we can use either the full goodwill method or the partial goodwill method. With full goodwill, the value of assets as well as equity is a little higher than what we would have with the partial goodwill method. On this slide, we look at the impact on financial ratios. So profit margin is net income over revenue. The net income is the same regardless of whether we use the equity method or the acquisition method. But with the acquisition method, the revenue is higher, which means that the overall profit margin will be lower. Leverage again is most favorable with the equity method, because with leverage we are looking at debt over assets. Debt does not increase when we use the equity method because we are doing single line consolidation, only the net assets are brought over. Whereas with the acquisition method, the debt does increase. Now, asset increases in both cases. So here we have assets going up a little because we have net assets. Here we have overall assets going up. But in general, because debt is going up, chances are that leverage increases, which is a negative. With leverage, lower is better and higher is worse. Comparing partial goodwill with full goodwill, in both cases, debt goes up by the same amount. But with full goodwill, obviously the asset amount is higher because the entire goodwill is being considered, and therefore the leverage ratio will look a little better. Moving on to ROE, which is net income over equity. The equity method gives us the most favorable ratio. So this ratio will be highest with the equity method. Net income is the same across the board. The equity will be slightly higher. The equity will be higher when we use the acquisition method because here we are considering the non-controlling interest. And if we use full goodwill, then the equity will be even more here because here we have non-controlling interest and we are considering the entire goodwill. So the best ratio will be with the equity method, followed by the acquisition method partial goodwill, followed by acquisition method full goodwill. With return on assets, we have the same situation. The current ratio is current assets over current liabilities. This is best with the equity method because the current liabilities don't change. And with the acquisition method, the current ratio will be less favorable compared to the equity method. The asset turnover is sales divided by assets. Now, this ratio needs to be calculated. With the equity method, the sales number doesn't change. The assets go up because we are considering net assets. On the acquisition side, with the acquisition method, obviously the sales number goes up and the assets also go up. So we need to calculate this ratio in both cases to figure out what is better. But if you look at the comments over here, in general, the equity method gives better ratios compared to the acquisition method. That is it for this reading.